All right, we're going. Hi, Cole. How are you?
I'm doing well. How are you, John?
I'm doing well. So, guys, welcome to another Ultimate Edge webinar series. This particular one, we're going to talk about credit repair. And more than that, we're also going to talk about credit score optimization, if that's what your goal is. I have an expert in both of those on the line with us, Cole Duran from National Credit Care. We've been working with National Credit Care for, I'm going to guess, Cole, probably over 5 years, I'm thinking.
The whole time that I've been here, we have.
Yeah, there you go. We recently became acquainted. Anthony works with us a lot. There was another gentleman who's going to do the webinar. Wasn't able to do so, but Cole has an extensive background. Why don't you tell us a little bit about your background first in credit repair, Cole, and we'll go from there.
Absolutely, absolutely. So, I mean, just like most folks, didn't know a lick about credit when I joined the team. I was a baseball player in college. Just really didn't have an idea on what I wanted to do. Was moving furniture, and actually, one of my teammates worked for National Credit Care. He was a marketing director here at the time, and he broke down a little bit about the company. And I said, "Yeah, I'd love an interview." And I started at the bottom of the company and really developed a passion within my company. Working with clients on a day-to-day basis, coaching them through, a consultation, how to improve credit scores, and seeing, the wonders that my program can complete. The accounts that we're able to help, resolve from clients' credit reports, resulting in increased scores, helping folks that were starting at a 530. My personal cousin, he was a firefighter. Yeah, a firefighter, 29 years old, living with his fiance at his mom's house, 530 credit score. I took him from a 530 to a 680. It took me 6 months. He had a pretty extensive file, but 530 to a 680, 6 months, got himself
That's
into a
awesome.
home. I mean, it's a game changer, and it'll change your entire life. So I developed my passion within my company, and it's some pretty cool stuff that we're able to do.
That's pretty cool. So let's go to results. What's the general result that National Credit Care has been able to achieve for their clients in terms of increasing score and that kind of thing, I guess?
Yeah.
We're kind of focused on credit score in the mortgage industry, so that's probably a good metric to use.
Absolutely. Absolutely. I mean, a lot of these folks need to close at, 620, 640. Obviously, if we can get them closed higher, 660, 680, that's our goal. We never want to just stop at a 620. We're never going to stop there. Our goal is to get you 700 plus scores as quickly as we can. And we give our clients the heads up. Hey, you told us you needed a 620 to close. You're at that mark. You can, head back over to your lender if you're ready to, for the home loan process. Currently, we're averaging a 20-point increase a month for our clients. I mean, it's
20
ridiculous.
points per month. That's pretty
20
significant.
points a month. Yep. And
Wow.
It's actually with clients typically adding 2 new derogatory trade lines along the way. Which, a lot of these folks, that's what we try to prevent, with our consultations is, explaining the do's and don'ts with credit. It's like, hey, if you already have established credit cards open with years of history, opening up new credit cards is not a good idea. And we're going to explain why.
All right.
Yep. It's just a lot of those misconceptions, those common misconceptions, that folks, chat about. We're going to, clarify that. And we're going to make sure that clients have the most financially sound game plan to improve their credit scores.
Okay. So, Cole, let's start by describing what drives the credit score, the factors on a credit report, so people can have a base understanding of that.
It's a great question, John. Great question. The majority of your credit score is actually calculated by your positive credit. Okay. And positive credit boils down to credit cards and loans, how they're used on a month-to-month basis, how to maximize your potential using your credit cards and loans. Credit cards are, don't ever have to close, right? You can have one open for 10, 20, 30, 40 years. Every 12 months of good payments, you're just stacking another year's worth of payment history towards your scores, and you're constantly building. Now, loans, on the other hand, a lot of our credit challenged clients, they're afraid of credit cards. They're told, oh, that's gonna decrease your scores. That's really gonna cause your scores to tank. Credit cards are dangerous, and it's not incorrect. You just need to know how to properly use credit cards because they are the number one tool to building rapid scores and long-term consistent scores.
Good point.
Credit cards are kicking in on 2 different categories a month, so you're able to gather 2 sets of points with a credit card each month versus a loan only one. And with the kicker with a loan, eventually you will pay it off, right?
Yeah, when you say loan, you're talking an installment debt, or is that also a mortgage? Is that correct? Are they lumped in the same category?
Yeah, a mortgage loan, auto loans, personal loans, student loans, any type of loan that is not a revolving account is going to eventually be paid off. And once that balance is zero, unfortunately, you lose all the payment history that's attached. So a
Got
lot
it.
of these clients, will pay off, auto loans. Yeah, I'm getting ready to pay that off. I'll have that paid off next month, getting ready to have my home this summer. Well, paying off that loan might not be a good idea. Your scores might tank. And then that home, this summer, that goal of a house this summer might not be achievable. So a lot of moving
Well,
pieces pretty much with credit, a lot of moving pieces.
what is the maximum, actually the optimum number and kinds of accounts on a credit report to optimize the credit score?
Great question as well. So 10% of your credit score is based on the types of credit accounts that you have. So 1 being a credit card, 2 being an auto loan, 3 being a mortgage, and 4 being a personal loan. Okay, we like to call that other. Now this can be a student loan, an American Express card with no limit. Those aren't kicking in on your report as a revolving account. That's an installment, okay, a personal loan.
Good to know.
Yeah, absolutely. So the 4 perfect types of accounts, that's 10% of your score. And that's something we're going to be able to, coach clients on. Hey, I really bring this up when I see credit challenge buyers that have maxed out credit cards, and they've gotten to a point to where their month-to-month paycheck is just not enough to get these things paid down because interest is taken over. And now interest is taken over. They're just not able to pay these things down. They're making on-time payments. However, the balance is not getting to a point to where it's below 50%. It's still hurting them on a month-to-month basis. So if, I have a client that doesn't have too poor of a score, has those type of items on the account and doesn't have any personal loans, that might be an option for us. Opening up a personal loan, using that amount, that those funds from the loan, pay off all the credit card debt.
Oh, clever.
And that way we're adding on a type of account that client needed. And we're also, working on our 30%, going to my pie chart, which we do have brochures. We have PDF brochures that we can mail out to, the office there in Hawaii, to you out there in Washington. I'm sure everybody listening in is either working with the office out there in Hawaii or yourself there in Washington. So if they're curious on, the pie charts and some visual updates, by all means, we can send that out to you and you can take a peek. But 30% of the score is credit utilization. And if we're able to get those credit card balances paid down, that's really going to help increase scores quickly.
Okay. And that's a question I get fairly consistently. Let's say we have a client that has good payment history and there's no derogatory payments at all. They're maxed out credit cards. That's driving their score down. They are able to pay down the credit cards. 2 questions around that. What percentage of the limit do you want the balance to be to optimize the score? And once they achieve that, how quickly does their score recover to a good score?
So it depends. Okay, as far as how much points you're going to receive by paying down credit card balances, it really depends on the status and the nature of the rest of your report. So, just like with a client, if a client just has, 1 medical collection on the report, getting that resolved is going to add a ton of points. It's worth 35% of the score. It's worth a lot versus an account or credit report that, let's say, has 10 to 20 accounts holding them back. Each and every one of those accounts isn't worth 40, 50 points like that medical collection is on person A, who has just the 1 derogatory account. And it's, at the same time, as far as, paying down credit card balances, if I don't have any derogatory accounts and I'm paying those down, I'm going to get a little bit more points than if I have other accounts, holding my scores down. So it's difficult to answer how much points you're going to get by, paying down credit cards, but it's 30% of your score. That's what you're attacking is credit utilization. So if I have 3 or 4 different maxed out credit cards, ideally you're probably going to get anywhere between 5 and 30, 5 and 40 points by getting those. And it could be even more. But it varies that much.
Okay.
There's a lot of variables that come into play there, but it will increase your scores. You're working on the 30% of your score. And there is a strategy. A lot of the folks, when they have these maxed out cards, they tend to look at that big one, right? That one that's glaring at them in the mirror every morning. They're waking up, it's just lingering, you're weighing on their shoulders, that $10,000, balance credit card with maybe a $12,000 limit. And then they maybe have, a couple other, $2,000 maxed out card, $3,000 maxed out card. They typically tend to think that they need to pay down that big one first, and that's going to do the most positive effects towards your score. It's not the case. We actually want to get more cards into a good utilization, so we're going to start with those small ones. If we can get the 3 small ones into a good utilization and then work on the big one last, that's going to do more for our credit scores.
Okay, good. Let's go to that derogatory stuff that you were talking about there. How quickly can you typically get derogatory items off a credit report?
I want to be I want to be clear as far as, working on accounts. The accounts that we are legally resolving, okay, from a credit report are labeled as non-verifiable and erroneous accounts. Now, whether these accounts are valid or not is what my team is designed to do is hold creditors and collection agencies accountable, okay, for what they have on your report. And at the end of the day, the fact of the matter is 95% of the debts that are sold out there today are sold in partial, which is illegal. Okay. They don't complete due diligence. They don't sell an 100% accurate file, which if any file is impartial, it's illegal for them to sell it, but it happens all the time. Okay. We want to look back a couple of years ago, enhanced recovery, portfolio recovery, collection agencies notorious for purchasing impartial debts went through $1 billion lawsuit because of this illegal activity. Now, who do they purchase from? They purchase from AT&T. They purchase from Sprint, Verizon, DirecTV. Now, did those creditors get a slap on the wrist? Absolutely not. Just the collection agencies. And yet, enhanced recovery and portfolio recovery are still operating today. So it just tells you, with all these debts out there, there's just not a large enough overseeing agency to make sure that everything is done by the books. That's where my team comes in. Okay, we are going to question and validate the debts that are on your report. We're going to hold the creditors and collection agencies accountable. If they're going to, report a medical collection of $20, which we see all the time, on your credit report, we're going to make sure that they have 100% accurate documentation. And, medicals are bread and butter. Any client with medical debt should be giving my team, a call, really ultimately calling you guys to get set up with us. But collections, we are very efficient in going and locating the material that they've made a mistake with or have lost. And then using the Fair Credit Reporting Act, now it's not 100% accurate and verifiable, has to come off the report. The bureaus then take it off the report. So I don't want to advertise that I'm just removing any type of derogatory or negative account that's on a credit report, because I'm not. Okay, the accounts at the end of the day that we are resolving are strictly non-verifiable and erroneous accounts, which just so happens that most of these debts on reports nowadays happen to be non-verifiable.
I've heard some statistic that said that a certain percentage of the derogatory reportings on credit reports are inaccurate. Do you know what that percentage is by chance?
Well, I don't, because it's changing. Last year it was, upwards of 70%, like 68, 69%. This year it's ever so changing. But we are seeing, that's what we do on a day-to-day basis, is review reports, give our clients consultations, set them up with their game plans, and then start work. And reviewing those reports, we're seeing countless accounts that don't have correct DLRs, DLAs, data last reported, data last activity. A lot of these accounts are just sitting on the report and they haven't been reported in 2 or 3 years. All these accounts are supposed to be, contacting the bureaus once a month. Creditors with positive contracts are supposed to be reporting once a month. And if they're not doing that, again, that's, those are grounds for removal, in my opinion. And that's what, we coach our clients on, say, hey, this is exactly why, this is accounts, perfect for us to work on. It's because of the mistakes. You can clearly see the mistakes here on your report. This is what we're going to capitalize on to get this thing resolved for you.
Okay. I'm going to discuss the process, what you do, in a minute here. But before we go there, let's talk to that client that has perfect credit. So they don't have any derogatories, but they want to optimize their credit score. What's the strategy for that particular person? What's the kind of accounts, the mix of accounts, and how do they manage all that?
Absolutely. And we've already touched, a little bit of touched base on a lot of this credit optimization, as far as, credit cards, how you're using those, where are your balance to limit ratios, how old are your credit cards? A lot of folks get, another common misconception is having more credit cards open is going to result in higher credit scores. It's actually not the case. Credit cards are built on averages. So let's say I have a client that has, 4 credit cards. Let's say 3 of them have been open 4+ years, but I have 1 new credit card that was opened up 3 months ago. Okay. Well, they pull down their average when opening up this new credit card. Okay. Let's say each of those other 3 cards had 5 years apiece. So they had about 15 years, 15 years of payment history, but they had 3 cards. So 15 divided by 3, we had 5 years of payment history kicking in on our score. And that's the largest category of any credit score is payment history, 35%. So they had 5 years kicking in. And when they elected 3 months ago to open up that new credit card, they had to now divide by, that 15 years of history divided by a 4th card instead of 3. So they're dropping from that 5 years of payment history to, right around, what is that? Just over 4. So that's going to decrease scores because they opened up that new credit card. So paying off and closing that new credit card actually is going to result in an increase in scores because our average is going to increase.
Okay.
Little things like that, having those, the 4 perfect types of credit accounts, that 10% of your credit score, making sure that you have those type of trade lines open and rocking and rolling. Do's and don'ts. I mean, I can't stress that enough, pre-qualifications and things like that, where clients, I then get a call from the loan officer. Hey, unfortunately, my client, 4 months ago was pre-qualified. She had a, 640 credit score, and I pulled today and she went to no scores. She paid off her only loan and then her scores, went off the table. So there's so much education that you can receive, and my team offers free consultations. It's nothing out of pocket. If you don't have a credit report, it's just a one-time $15 fee for us to pull a full tri-merge credit report. And did I mention we're integrated with the bureaus? So this is a full tri-merge, real-time report, the most accurate report. What do the bureaus have for you today? And it's a soft pull. There's no inquiry added. It doesn't hurt you. It doesn't drop your scores whatsoever. And again, the consultation's free. So if you're curious, hey, can National Credit Care still help me out, even though I don't have, late payments and collections and things like that? Absolutely. And you should, your eyes should light up, because it's not going to cost you anything either. You're going to get a free consultation. Just call in, again, to either John over there in Washington or the office there in Hawaii. They're going to get you hooked up with us. And then, we'll provide you that full consultation and tell you how to, maximize and optimize your credit scores.
All right, which is awesome, guys. We really like that about National Credit, because they offer that for our clients. So, Cole, is there an optimum number of credit cards? Let's say they're all about the same age, so they're not going to get a new one. Is 3 credit cards better than 4 if they're all same age, or is there 1 better than 3, or what?
Well, ultimately, a client doesn't need more than 1 credit card. However, if I have a client that's, let's say, scoreless, a clean slate, I'm going to recommend that client open up 2 credit cards. That way we can start accumulating more payment history. Okay. That's kind of where that comes into play. But once you have those established trade lines, opening up, again, new credit cards to maybe get some more payment history works against us, because we're pulling our average down. So it's really all about timing, where you're currently at with your current situation, as to what direction I need to take, whether I need to open up an additional credit card, or, hey, I already have my credit cards, I don't need to open up anything further, just need to focus on, my balance to limit ratios a little bit more closely. Things like that. I'm sorry, what was the rest of your question there, John?
Well, you've answered it well there. So let me ask 2 more questions around that. Mm-hmm. What is the best ratio for the maximum credit score on credit cards? Is it 3% of the limit, or below that someplace, or what?
That was it. That's what I wanted to touch base on. So what we preach to our clients, the goal is really ultimately don't use more than 10% of your credit limit. Now, you're positive between 10 and 30%. So just in case of emergencies, I tell folks, hey, imagine there's a little, white picket fence at 10% of your credit limit. Try not to pass that. Now, in case of emergencies, built up, the Berlin Wall, a brick wall up at 30% of your limit. Know that you never want to cross it. But just in case of emergencies, you are still positive up until that point. Once these credit card balances move on past 50% of your credit limit, that's where they're going to start to hurt you. Okay. If the banks, your bank is reporting a balance over 50%, scores are going to take a little bit of a hit each month. So that's where you definitely want to get those balances down. And the cool thing is, credit cards can't make any money on you when you're just using 10%. So folks ask me, well, how am I going to get my credit limit increased? How do I get more room to play with on a month-to-month basis? Just use 10% of your credit limit. Hey, I personally started off with a $500 credit limit credit card when I was 18. It now has $7,000 limit. And I've never requested that my credit limit be increased. I just don't use more than 10%. I don't use any more than 10% of my credit limit. And because the bank can't make any money when I'm just using 10%, they want to increase my limit to scare me into, using a little bit more. And now I have a higher 10% to use on a month-to-month basis.
Great. Okay, so a question I get asked quite consistently is this. Should my client have 0 balances on their credit cards consistently and just not use the credit card? Or is it better for their credit score if they use the credit card, occasionally charge something and pay it off? Is there a difference?
Another great question. There is a difference. So with credit cards, the important thing to remember that they are showing that they are open, active, and maintaining low balances. Now, when I say maintaining low balances, I do not want clients leaving a 0 balance on a card for multiple months on end. You're giving the creditor the option to close your card due to inactivity. Okay, certainly don't want you to have your card closed and then all that payment history that you've accumulated gone, washed away. Okay, so we do want to make sure that these cards are being used. Now, ideally, let's say we have 1,000 limit credit card. So we have $100 to play with a month, right? Now, if I have a smaller, in-store credit card, let's say with like a Kohl's card, that's a $200 limit, $20 is not really that much. And they're wondering, well, what can I do here? Well, I don't have to just use the card, $20 each month. I am positive up to 30%. I could go out and use maybe a $50 charge and then just make minimum payments for the next 2.5 months. And then the balance will be zero. And then I'll go out and use the card again. So some folks elect to just use 10% of their limit and just use them once a month, pay them off on time, go out and use them, another 10% the next month, but you don't have to. Let's say I have a client that has a $10,000 credit limit, $1,000 a month to play with. Certainly, let's say this client wants to ring up an $800-900 balance, but doesn't have the $800-900 to completely pay it off at the end of the month. Still okay. Still under 10% of your limit, and as long as you're making your minimum payment on time, you're fine. So if we want to, ring up an $800-900 balance with this card, and then for the next 10, 11, 12 months, just make, minimum payments of $50 to $100, that's okay. We're still under 10% of our limit. So it depends on the card that you have, depends on your current situation, but ideally good practice, just use 10% of your credit limit.
Okay. Let's switch gears a little bit here, Cole. Scoring models, algorithms used. Is there a difference between a mortgage credit report and an auto dealer credit report and a credit report achieved or acquired online and all of that, and how they compare?
Yes. So there's four industries of credit scores. You have the online industry, which everyone is popular with, your Credit Karma, going to the bureaus directly, Experian, TransUnion, Equifax, your Discover scores, your FICO scores, things like that. That's the online industry. You have the auto industry, you have the mortgage industry, and then you have the banking industry. Okay, so you're going to have some different scores per those industries. Now, ultimately, the items that are on your credit report are the same. That's not changing. It boils down to how your items are being graded, how they're being scored. Now, for mortgages, okay, they're scored, they actually use the Beacon 5.0, Classic 04, and Fair Isaac version 2 algorithms. Okay, for online industry, which is the most popular, most folks are utilizing Credit Karma, things like that. It's what's called a Vantage model. And the biggest difference between those two models is really how they're scoring paid off debt. So a paid charge off or a paid collection, or any medical debt, whether there's a balance or not. So if we have clients that have those type of accounts, those online scores are typically a lot more inflated than if a client doesn't have those type of accounts. There's just ultimately Freddie and Fannie Mae, they score your credit report. That is probably the best thing to take from this, part of our webinar today. Freddie and Fannie score credit reports. The bureaus do not. Experian, TransUnion, and Equifax are like large filing cabinets. Okay, they're in the data storing and data distributing business. So when you have, your mortgage professional inquire, your credit report, they have a credit provider, Credit Plus, CBC, Credit Technologies. Those credit providers are reaching out not to the bureaus for scores, Freddie and Fannie. Freddie and Fannie gather the information from all three bureaus, and then they use the correct algorithms for, in this case, a mortgage algorithm, and then they send that back to you. And that's where you see your mortgage algorithms where it says Experian's this, TransUnion's this, and Equifax is this. Again, for the banking industry, scores are going to be a little bit different. For the auto industry, again, a little bit different. And that's just how they're scoring the items that are on your credit report. The accounts are all still the same.
Got it. So I'm going to pause here, Cole. We have some questions coming in from the people that listen to you chat away here with us. Thank you for that. First of all, do you actually have an office in Hawaii? Is that what you're saying? Or you just help our clients over in Hawaii? And how does that work?
So no, don't have a physical location in Hawaii. We have a regional director out there that will bounce, to and from Hawaii. Our office is located here in Denver, Colorado. So we're in Mountain Standard Time, just in case anyone is curious. And how to communicate with my team. Typically, John or the office in Hawaii is going to get you set up with my team. That regional director out there in Hawaii. His name is Devin Norcross. Again, it's Devin Norcross, Anthony Akabuchi there in Washington, and myself is Cole Duran. I'm just stepping in to help out with my team today and answer the questions for you guys. But yeah, you'll get connected with Hawaii, that office, or John there in Washington. They're going to get you set up with my team, and we'll reach out and get you guys squared away from there.
Awesome. Okay, here's a couple of specific questions on credit. A client has a couple of large collection accounts, one from a timeshare company and the other is a student loan. Both are about $12,000. Can you assist in removing those derogatories from the credit report?
Excellent question. So let's first talk about the student loan. Now, student loans we can resolve student loans, but it really boils down to the type of account. So with student loans, is it in default? Is this in collections? If it is in collections, most of the time that account is not going to come off. What we have our clients with student loans in collections complete is a student rehab program. And we're going to walk them through the process on how to, apply for that student rehabilitation program. Ultimately, the student rehab program, once you have that set up, a client will agree to pay 9 on-time payments, typically 9 months, but you can do payments every 2 weeks and have this complete in 4.5 months. I had a colleague complete this. But the point is, after that 9th on-time payment, they take all of your collections out of default and place them back into good standing. So all the collection remarks go away and the account goes back into good standing, which is a game changer, increases scores. But again, that's on our client's end. That's what they'll complete. Now, as far as a $12,000 collection, it really, I think you mentioned Time Warner.
It's actually a timeshare.
Okay, a timeshare. Well, yeah, timeshares, it boils down to the details. How old is this account? If we can go in there and resolve it or not. If there's, let's say, an account that we cannot resolve, we're going to coach our clients on how to settle these accounts out. We have our clients, settle between 10 and 40%. We tell them when to call. We give them the pitch. We just can't complete the call for them, as we're not them, and the companies won't, we can't speak on their behalf. However, we're going to give our clients every tool needed to complete that settlement, and our client will complete that settlement, fill us in. Ultimately, if that collection is settled, what are we going to have? We're going to now have a zero balance collection on the report, right? Because collections, we know, stay on reports for 7 years from the day that they're satisfied. So client will still need our help. Does that client need our help right now? Probably not. We're probably going to be, that specific client, if those were the only 2 accounts they have, I would be telling that client, hey, need to start this student rehab program. Here's the steps to take. Here's how to complete that. As far as this Time Warner, it's probably best that you settle this account out. And once it's settled, then you can give me a call and I'll go ahead and take care of that for you. And then
settle the derogatory ones and then work on credit repair. That makes sense. Another specific question here. A family member had some medical problems and they dealt with them with credit cards. So they have 3 major credit cards. The credit card companies are willing to do a short pay now, so to pay them off in full. So what should the client do? Should they get something in writing from the credit card company? Should they do the short pay? And how do they minimize the long-term credit impact of doing that? And then what do they do afterwards to start boosting their credit score again?
Well, this is a specific scenario. So from what I've gathered is that client had medical bills, used their credit cards to pay these medical bills. So right now, what do we have? We have high balance credit cards. And as far as this company that she's contemplating working with, it sounds like a debt consolidation company where she's going to set up, those debts are going to be, placed under one file, and she set up a low monthly payment to pay that off.
I think from reading this, Cole, is that they're dealing directly with the 3 credit card companies they have, and the credit card companies have all been willing to accept a short payoff.
Okay. So if they're going to accept a short payoff, now the kicker, I'm assuming with completing a short payoff that they're going to be closing the credit cards. Now, as we mentioned, when credit cards close, what do we lose? We're going to lose payment history. So ultimately, what I'd be taking a look at is how long these 3 credit cards have been open. Now, it might be financially a better decision to complete the short pay, because we're going to pay less money. However, if all 3 credit cards, and if those are all 3 of her open credit cards and they all 3 close, scores are really going to drop off the map. She's going to lose all of her payment history. She's losing her revolving accounts. Her revolving accounts factor into 65% of her score. So that's a situation where we need to take a look and see if really ultimately completing the short pay is really the best decision. it sounds like it's going to drop her credit scores. Yeah, it might save her a little bit of money now. All right. But let's say this client was wanting to, obtain a home loan and her scores drop, from, closing these 3 credit cards. Let's say she's at a 660, 640, and she closed her credit cards. She's probably going to be south of 600. Okay. Below a 600 score, may not be able to even obtain a home loan, at this point in time. So what did that really cost her? What is she really saving by completing this short pay? That's something that we would need to take a look at.
So, Sherry, that's a good question. I think that this particular situation is a situation that might be best explained if you were to have that initial conversation with National Credit Card, the National Credit Care that Cole talked about earlier, that doesn't cost anything at all. It's a consultation. So let's chat about that. So typically, guys, so you understand, clients come to one of our loan officers in our Hawaii or our Washington office. We talk to them. There may be some need for credit repair. There may be some derogatory payments that are reporting incorrectly on the credit report. And then we're going to send them over to National Credit Care, make the introduction. And then after that, Cole, walk us through what happens with a client when you're working with them to start the conversation with them and all the way to maybe working with them to help them with their credit.
Absolutely. So my team is going to reach out to you as soon as we have that introduction email. We're going to reach out to your client. We're going to discuss your report. We're going to provide you that consultation. We're going to discuss how we can help, how we're going to maximize your potential. From there, let's say we get the client rocking and rolling. Pretty much our clients receive monthly result letters, every 30 days. They start receiving results from the bureaus themselves. Okay. TransUnion, Equifax, Experian are mailing out result letters showing what accounts were worked on, what accounts were resolved from your report. Okay, and what accounts were verified. So our clients, they touch base with us once a month when they get their result letters, and we go month to month until scores are high enough and we can close on the home loan. Now, we also do, to bring up, we have a purchasing phase part of our department. So before we have our lenders, pull the final credit report for the home, we're going to make sure that this credit report is going to meet all underwriting requirements, whether this is FHA loan, conventional, USDA. My underwriter, Merritt Dietz, is going to be giving you folks a call saying, hey, just want to make sure that, we're going to be able to hit this time frame that we're looking at. Client mentioned we're going, conventional loan here. We pulled a 667 Vantage score on our end. There's just one dispute comment on the credit report. This is why we have Merritt. She's absolutely crucial. If there's dispute comments that need to be taken off the report before that final pull, she's going to have that complete with your client in 24 to 48 hours. And then your client gives you the call to make that final pull. Okay.
So you mentioned earlier that you're getting an average of 20 points improvement in credit scores on a month-to-month basis. What's the typical time frame that someone would be with you doing credit repair typically?
Yeah. So with that 20-point increase a month, an average client is ultimately with us really 3 to 6 months. 3 to 6 months but there are clients, I had a client that spent 8.5 months with me. I just got him closed. It took 8.5 months. Now he had a $27,000 medical collection. Okay. It took us a little time to get resolved from the report, but we finally got that accomplished. And it really was, a game changer. He only had one item on his report. That one item held almost 100 points. Okay. It was about, I think, 92, 93 points of an increase getting that resolved. That saved him thousands on the life of his mortgage. But yeah, that situation, that client took 8.5 months, but he stuck with us. But for the most part, 3 to 6 months is really what any client will need to spend with us. And there's 2 questions. When clients start with me, it's how long is it going to take to get my scores high enough to obtain a home loan? And then there's 2, how long is it going to take to give me a clean slate? Okay, get all this stuff resolved from my report. So you just want to be specific, when you're contacting my team with your goal. Okay, know what you want to do. Hey, it's April right now. I would really like to get moved in by August or September. So, if that's the case, hey, I need to be out of my rental in 60 days. We're going to establish that situation with your client up front because, based on our time frame that we have, the financial well-being, the financial status of our client, that's where, we're going to, decide which avenues we can explore.
Okay. Cole, what is the cost to do credit repair typically?
Absolutely. It's a great question. So it's typically $89.79. That's our pricing around the nation. Our pricing does change upon your resident state. But for the most part, it's an $89 to start. It's $79 a month. And we're just a month-to-month program. Pricing might change depending on your resident state. However, the program itself does not. It's always a month-to-month program. Clients can cancel whenever they'd like. They truly can use us as little or as long as it takes to get that score to where it needs to be. Some clients elect to continue with us afterwards. Let's say we needed I needed to be out of my house in 30 days, just need to get this loan done at this 620, but I would really like to refinance this as soon as my scores are up at that 680, 700 mark. So there are clients that will stick around with us to, improve their financial well-being, getting those 700 plus credit scores. But most of our clients, they'll use us until they have those keys in hand, and they'll give us a call and shut us down.
All right. And am I correct they get a discount to that price by going through Pacific Road Mortgage when we refer them over to you all?
Absolutely. Absolutely. So that $89, that's actually, I was already, including your $100 credit. Okay. It's actually $189 to start with my program. Okay. $189. Okay, when you're working with John or the office out there in Hawaii, what Devin, what Anthony Akabuchi has set up with you guys is that $100 credit. So upon starting with us, it's just that $89 for you guys, as opposed to folks that aren't working with John or the office in Hawaii, aren't working with a friend or family member already in the program. It's $189 to get rocking and rolling. So that $100 credit will really help these clients stay motivated to continue to work with you guys until they're ready for that house.
All right. So guys, let me just kind of summarize here. We've been working with National Credit Care for, as I said, at least 5 years, I think. $89 to sign up with them, $79 a month. You're going to be there an average of 3 to 6 months, something like that. That can have that increasing credit score, $20 per month average, 20 points per month average, can have a very significant impact on the rate that you're getting on a mortgage. It's well worth the investment if you want to prepare for purchasing a home and you want to get the best rate on a mortgage, because rates on mortgages are determined by your credit score. The higher your credit score, the less expensive it is to get that mortgage. And some credit scores which are lower can't even get certain kinds of mortgages, and the kind you're going to end up with is a more expensive loan. So once again, it makes sense to check out your credit, get prepared if you want to purchase a home, and do a little credit repair if it's needed, and it can really pay off in the long run.
Absolutely.
Any additional comments?
Well, I want to say thank you for having me today. I appreciate your time. I appreciate everybody listening in today. I hope you've learned something today. I brought some value to you guys. There really is a ton more. I can talk all day about credit. So I encourage you, if you have individual questions, you have a little bit more, would like to have that consultation to figure out if you're doing everything possible to increase scores, really connect with John or that office out in Hawaii. They're going to get you linked up with us, and we'll get you taken care of.
Absolutely. Their customer service is excellent. That's one of the things we've really loved about National Credit Card. They do good follow-up. They call us and keep us updated on your status and progress, and they'll do the same thing with you. Cole, thanks for your time today. I really appreciate it.
Thank you so much, John. It was a pleasure being here. Thank you.
You bet.
Take care, guys.